How do commodity ETFs use commodity futures? Imagine trying to track the price of something like oil or gold without actually storing barrels or bars. That's where commodity exchange traded funds, or ETFs, come into play. Instead of holding the physical commodity, these ETFs mainly invest in commodity futures contracts. A futures contract is an agreement to buy or sell a specific amount of a commodity at a set price on a future date. This method makes it easier and cheaper to gain exposure to commodities, especially since storing or transporting things like wheat or livestock can be complicated and costly. The ETF managers buy futures contracts with expiration dates set months or even years ahead. As these contracts get closer to their expiration date, the managers sell those contracts and buy new ones with later expiration dates. This process is called rolling the contracts. The goal is to keep the ETF's exposure aligned with the current market prices of the commodities. However, the way futures prices behave can impact the ETF's returns. When futures contracts with later expiration dates are priced higher than those expiring soon, it's called Contango. In this situation, the ETF sells low and buys high during each rollover, which can eat into returns over time. On the other hand, if near-term futures are priced higher than longer-term ones, it's called backwardation. During backwardation, the ETF sells high and buys low, which can boost returns. To reduce the negative effects of Contango, some ETF managers diversify their holdings across different futures contracts with various expiration dates. This helps smooth out the impact of changing prices. Some commodity ETFs, especially those for metals like gold or silver, may hold the physical commodity directly, which keeps their prices closely tied to the spot or current market price. But most relying on futures contracts because it's more practical and cost-effective. Investors can buy these ETFs through regular brokerage accounts, just like buying stocks. They offer liquidity and easy access to commodity markets without needing to trade futures directly. But it's important to remember that because they depend on futures contracts, their performance might not exactly match the current spot prices of the commodities. Market conditions and the way contracts are rolled over can cause differences. Some commodity ETFs also offer special features like leveraged or inverse exposure. These aim to amplify gains or provide returns opposite to the commodity's price movement. But they are riskier and usually meant for short-term trading rather than long-term investing. In essence, commodity ETFs use commodity futures contracts as a practical way to mimic the price movements of commodities. This allows investors to add commodity exposure to their portfolios easily, without dealing with the complexities of physical storage or direct futures trading.